Building out key positions is vital for your portfolio. Hi, I'm Kevin Castaneda, and this is Kev's Mindset. And today we're going to be talking about consolidating your portfolio to companies that you truly love and have truly studied and researched and know everything about and have high conviction for in the following years. So recently, I've been looking at my portfolio, and just to be pretty kind of transparent with you guys, I have more than 5 positions in my portfolio. I'd have to count it up, but I think I have like 9. And I realized, okay, I have 9 positions in my portfolio. Which companies within my portfolio do I truly feel are going to do incredible over the next year, 2, 3, 4, 5, 6 decade? How many of those companies am I actually really bullish on versus which of these companies am I buying because I'm somewhat bullish on, I think they're going to do pretty well. And why is my portfolio so wide with a smaller sum of capital? Now, someone like Warren Buffett has talked many times about how when he was younger, he could get crazy returns, maybe even 80% year over year returns. And how would he do this? He would do this because he found companies that he truly loved, that he felt were unfairly valued and that they were cheap, and he saw their long-term vision. And he would invest in these companies. Maybe it was 1, 2, 3 companies, 4 companies, something along those lines, but he would never stretch it to 10, 15, 20 companies. Why was that? Because he had a smaller sum of capital. He wants to build his capital faster, and he has high conviction in these companies. So even if he loses all the money and his decision turned out wrong, it's not a huge sum of capital that he could so he could easily go and work to build this back up. I'm in a similar scenario to that, and I think I've messed up my approach in investing, and honestly, I like to admit when I've done something wrong. And I've built out about 9 positions, which in the investing industry is pretty normal. 9 positions, if anything, is kind of a bit small. Some people like 10, 20, 30, 40, 50, 100, 200, 1,000, ETFs with 500 companies. A lot of people like being diversified because it allows that when the market falls, you fall less. But when the market rallies, you also make less than someone who's all in on one big growth stock or something like that. So I'm looking at my portfolio, and there's about 5 companies that I really like in my portfolio that I'm crazy I'm crazy about. I think that they're incredible companies. These companies are Affirm, Enphase, Nvidia, and Facebook, and lastly Tesla. Now, my problem with Tesla has been that I bought in at 680, and at that time I had a smaller portfolio. I wasn't working yet. I wasn't able to build up the position, and I made the mistake of only buying a very small part of my portfolio into Tesla. Now that position's up about 70%, and now I ask myself the question, do I build this position out knowing I love this company, or should I wait for dips? And it's kind of just this dilemma within your own head. So now that I'm looking at all these companies and I'm like, okay, what do I want to do? It's a bit tricky because you're like, okay, I want to build out these positions, and you want to build them out to certain levels, of course. Now, I look at these companies and I'm like, okay, I have more than the companies that I just said. So my firm position is built out to about 25% of my portfolio, which is transparent. Being transparent, it's about $1,000 in that position. My portfolio is at about 4,300, so it's a little under 25%. But it's a rather large position. Now, if I break down to 5 positions as I build my portfolio, I want to have 5 positions at $1,000 or a $5,000 portfolio. Now, I'm looking at my portfolio and I'm like, okay, why do I own so many other companies that, yeah, sure, they're good companies. Like Disney's a great company. AT&T, they're a great company. Amazon, Google, great companies. But I don't see as much growth in them, whether it's because they're established companies, whether it's because I think it's going to take more time, whether they're not growth companies, whether I don't see their margins increasing, whatever it is, I don't see as much growth in these companies, and I don't feel as much conviction about these companies. Now, of course, they're kind of like a safety net, because do I think Amazon's going to go away next week? No. Do I think Google's going to go away next week? No. Do I think Disney's going to disappear? AT&T is going to disappear? No. I don't think that any of these companies are just going to, dissipate into the air. But I think it's important for investors to realize that there's only so many funds that you have in your portfolio. And when you stretch those out between so many companies, your potential returns kind of go lower. Because let's say you have 10% of your portfolio in one company. You expect this company to be a huge growth story. This company doubles in a year, right? Now that 10% of your portfolio turned into 20% of your portfolio. Well done. Let's say it was $10,000 portfolio, your $1,000 position turned to $2,000. That's good. But here's the problem with that. If you had, let's say, 25% of your portfolio in that position, and you had a $10,000 portfolio. You had $2,500 in that position. Now it grew to $5,000. Now that's now that you have 50% of your portfolio in one company, assuming that the other one the other half stayed stagnant, of course. But if you have your whole portfolio, let's say the whole 10,000, now it doubles, same math, double, and now it's $20,000. So if you have high conviction in a company, it's way better for you to go ahead and build out that position and invest in those companies that you truly love and truly see growth in and see high opportunity in. Because when you get stuck with companies that you like them, you like their business model, but you're not highly convicted about, well, one thing that happens is you end up selling them for a loss, whether it's to build another one that has an even bigger loss or whatever it is. But it's way better for you to build out positions that you're truly passionate about, companies that you see a lot of growth in. Because I'm currently in this dilemma now. I have a lot of great companies in my portfolio, but there's companies that I see more opportunity in. Now I want to build those positions out to higher levels, and I can't do that because I'm kind of restrained from the other companies that I own. And I'm green on all of those, so it kind of makes sense that I sell those and build out the other positions. But then another problem is, okay, let's say you bought in at a time where it was a lot cheaper, and now you have to average up. And you have to kind of realize, okay, what are you expecting? What are your growth rates? What are your targets, etc.? And then if this price that the stock's at now is still reasonable for you, then yeah, I mean, it doesn't go out of the realm of possibilities that you build out that position a little more. So those are just kind of my 2 cents for the day. And I really wanted to express how important it is that you build out certain positions, especially if you have high conviction in them. And I made the same mistake myself, building out positions just kind of for the heck of it and to be well diversified, as opposed to going for companies that I'm truly passionate about and I think are going to do incredible over the long term. So thank you so much for watching this video. Leave a like if you did enjoy. I know this was more of a talking video and I'm just like letting you guys know what's going on in my mind, but I think it could be very useful for a lot of you, especially if you're kind of conflicted within your own portfolio. So let me know what you think in the comment section down below. Is there anything I missed? Is there anything you'd like to talk about? I always love responding to you guys down there. Thank you guys so much for the support that you guys always give. Go ahead and smash the like button if you did enjoy, and subscribe if you do want to watch more of my content in the future. Thank you so much for watching. I'll see you in the next one. This was Kev's Mindset. Keep investing.